I don't think everybody needs an advisor. I think if you are on a trajectory to build substantial wealth for yourself or have some bigger liquidity events, then 100% you should have somebody and you want to be strategic about it. But there are others that just really want to make sure that they are retiring well and they're sort of just going to continue to accumulate at a more modest pace, which is great, but just different. Then I think that's much too early.
By 2030, women are projected to own more than $30 trillion of U.S. wealth. That is the largest intergenerational shift in American history. Anna Ninjakonte spent nearly a decade inside of wealth management firms, mastering investments, estate planning, and tax strategies that women in her family never had access to. Then she left to build something different. Today, she's the founder and CEO of Poder Wealth Advisors, a fast-growing Baltimore-based RIA serving high net worth women navigating some of the biggest financial transitions of their lives: divorce, inheritance, and selling their businesses. Anna is a 3-time Investopedia Top 100 financial advisor, one of Financial Advisors Magazine's 10 Young Advisors to Watch, and a brand ambassador for the CFP board. And she's quietly become one of the most watched voices in the next generation of RIA leadership. So far this series of Wealth Unfiltered, we've discussed the institutional case for private markets, how to vet a sponsor, and most recently we had Ramez Fakorian, who walked us through how to fund the allocation. Today, we asked the practitioner's question: what does this look like inside of a real RIA? And how do RIAs today incorporate alternatives like multifamily into their clients' portfolios? And how does a modern fiduciary incorporate alternatives like multifamily into their clients' portfolios? And how do they build a firm around doing it well? This week on Wealth Unfiltered, Anna Ninjakonte walks us through the practitioner's playbook. All right, everybody, I'd like to welcome to the program Anna. Thank you so much for being here.
It's my pleasure. Thanks for having me, Samantha.
Absolutely. So I want to dive first into your background. So I understand you spent over a decade in wealth management at other firms before you decided to go out on your own and create an RIA that is specific to women. So if you could, I'd like a little bit of your background, and then I'd love to dive in specifically to your company.
Yeah, so I sort of fell into wealth management. It wasn't necessarily a career that I really thought was going to be my future, but I found that it utilized so many of the skills that I really enjoy. I always loved math. I always loved money. I always loved problem solving and really finding an efficient way to get from point A to point B. That's always been my skill set and my interest set. So, I've always enjoyed interacting with people and helping folks solve their problems. So it really was a natural fit. Started my career at Bernstein Global Wealth Management, did some work at some corporate trustee work as well. And then my last sort of industry kind of corporate gig was working at RBC Wealth Management. There was where I'd say I really got a sense of what I wanted to be doing and who I wanted to be working with. So like most wealth management firms, we were really focused on retirees. We were doing a lot of retirement planning. We were mainly focusing on portfolio management, and we were doing sort of more traditional wealth management offerings. And I recognized that there was a lot of complexity that we were not addressing from other prospects that were coming in. So we had a ton of folks coming in that had stock options or had businesses, and they were on the younger end and they really needed advice, but they weren't necessarily the ideal client, especially as at the time, a lot of wealth managers are really moving up market. And so they're focusing on more and more high net worth families. And at the time, we were looking at a $5 million portfolio size minimum, which excludes a lot of folks. And it's worthwhile business model, no issues with that whatsoever. However, I recognize that there were a lot of people who were going to be there in short order, but really just needed some support. Let's say 18 months, 24 months, 36 months, like 1 to 3 years before a liquidity event, and they were not being appropriately served. So I made the decision to start my own practice to be able to address those very specific concerns and very specific niches.
Fantastic. So when you looked at that, you noticed that it was obviously about more of the underservice of that income profile, I would say. But
Yeah.
were there other things that were either missing or that you really found were reasons why you started going more toward leaning towards women?
Yeah, so I would say I think that there's a personal reason and then there's also just a market reason. I also felt really strongly about working on values alignment. I found that there were a lot of clients when I was still in corporate that were coming to us and saying they really wanted to invest in according to their values. And that was very, very much dismissed at the time. And I think that's understandable. Like that space has very much evolved over like rapidly evolved over the last 10 to 15 years. And so I think there were a lot of advisors or firms that were operating on an outdated model or position on that front. So that was another opportunity. The vast majority of those clients were women, to be candid, that were asking for that. So they were very successful, but they wanted to make sure that not only were they achieving having tax efficiency and having a really well constructed portfolio and thoughtfully constructed portfolio, they also wanted that values alignment piece, which was not necessarily available at a lot of the firms that I was considering or working at. The last thing I would say is I have a soft spot for women. I was raised by a single mom, and I feel really strongly that there are so many women who are incredibly smart, incredibly driven, incredibly capable. They sometimes can feel intimidated by walking into a wealth management office where it's only men, especially if we're talking younger demographics that are their dad or grandfather's age. And so that was something that I really wanted to fill that gap. I really wanted to create a space where women could be very intentional about their wealth and not necessarily worry about or experience judgment from the professionals that they were seeking support from.
Yeah, absolutely. So your company is it Poder Wealth Advisory?
Well, that wealth, yeah.
Okay, amazing. As we're mentioning, it's built to geared towards women, but
Mhm.
I think one of the other fundamental things that you kind of touched on is that there's a moment that keeps happening for women where this is really lucrative for them, and it's a lot of these like big life transitions. So I know
Mhm.
that you touch on obviously there's a lot of divorce, there's
Mhm.
inheritance that happens from deaths in the family, there's their business exits and acquisitions. So when you talk about all of these different pieces of these life transitions, what do you think is the industry lacking that really made you say, "I should really help them and guide them through this process?"
Yeah. So I think there are a few things. The first I would say is we typically are only talking to folks when they have the money already. If you're thinking about a liquidity event or planning for a liquidity event, whether that be like equity liquidity event, meaning you're an employee or you were an investor in a company and you're having a liquidity event, or whether that be exiting a business, that's really a multi-year planning event. Like you have to be in there. If you're going to do it effectively, I'd say at least a year, but ideally 2 to 3 years beforehand, because when it comes to certain tax moves, elections, structures, maybe setting up estate plans and doing a lot of that deeper thinking before things get really busy and hectic and you have to give somebody an answer and you have to make elections and thinking about spreading things out over multiple tax years, like you just have to be very proactive. And the challenge is, and I'll give you an example for a client that I have that just had a huge liquidity event last month, multi-million dollar liquidity event. She's in her early 30s. Not typically what an advisor would be working with. She did not have a ton of wealth. She had a very high income. So think mid multiple six figures, half almost to $1 million. She's doing great, and she's saving and investing along the way, but she had a significant because she was a very early employee of a venture-backed startup. She had significant stock options of different types, and the type she was getting changed for multiple years over that time. So she and I have worked together for the last 5 years, and we've strategically made decisions around options, exercising tender offers that have come as they've raised subsequent events. And now we're at a place where she has 15x her wealth level and she's had a multiple seven-figure exit this year and she's in her early 30s. That's not a typical profile, but there are certain areas of the country where you can't spit without hitting one of those people. And so it's a real underserved market and I love being able to give them the time and the focus to make the good decisions for years before and set up the infrastructure for years before so that they can most effectively capitalize on that event. For business owners, it's the same thing. There are lots of conversations that need to be had with your CPA, with your business attorney, with your estate attorney, with your tax advisor, M&A advisor that need to happen for years in advance. And one of the things that folks typically don't like, people are busy and life gets hectic. Our real goal is having those conversations with people about what do they want their life to look like? What do they need from an exit number standpoint for their own personal financial life? And what are the steps that they need to take to set themselves up well, and really holding the pace and holding space for that vision and being very clear about the vision and the numbers, actual execution steps that need to happen in order to get there is what we do. And I think it's an area that our business does not typically do. Folks will either, maybe they might have a serial entrepreneur client. And so, yeah, they've had a couple exits, they've got the money already, and then they'll advise them on subsequent. But when we're talking about those first really big numbers in someone's life, they're usually not there and they're usually flying blind.
I love that that's your focus. I agree wholeheartedly. I think that I mean, go back to just the client themselves. We aren't very educated as a society on our
Yeah,
finances. It takes us wanting to do it and us doing it on our own a lot of the time to actually get that understanding of even how I mean, I know people who don't even know how to checkbook is anymore, right? So like so
for
I think
sure.
I think the client first mentality of even knowing to come to you, but once they do that, a lot of times, like you're saying, I feel like you guys have a really unique perspective of how you approach these clients. What I found, I mean, and I think this speaks to this. So I was reading that you have been a 3-time Investopedia Top 100 advisor. You also are one of the young advisors to watch, and that comes from the Financial Advisor magazine. I mean, I think that like there's a lot of credibility in what you're doing, and it's speaking to a broad audience, especially when you talk to how underserved the younger demographic is or those first time people. And
Mhm.
what I want to know from you, as you see these people coming to you for the very first time, is there something that you would suggest? I don't know if it's like a steak you've seen a lot of times for the first person, or if it's something you're like,
Mhm.
do this before you come to us, and this can
Yeah.
set you up for success.
Yeah. So I think when you're very visible, you tend to get, which is a plus, or it's a side effect of something that's necessary as an advisor. Like you have to be out and have your name be visible and get a lot of traffic and potential leads. The challenge with speaking specifically to someone who's having that first event is sometimes you get people that are too early. And what I mean by too early is they may have a great income, but they may not have established really solid habits, or they may be newer to that income level. And so I think there's a little bit of time that it's not worth hiring an advisor, even if you have a high income, if you haven't established those really good habits. I also think this may be a controversial take, but I don't think everybody needs an advisor. I think if you are on a trajectory to build substantial wealth for yourself and or have some bigger liquidity events, and 100% you should have somebody, and you want to be strategic about it. You should 100% have a professional in your corner. But there are others that just really want to make sure that they are retiring well, and they're sort of just going to continue to accumulate at a more modest pace, which is great, but just different. Then I think that's much too early. I also think that when folks are not familiar with the different professionals that they should have in their life, even when they are at a more high level. So I'll give you an example. I have a newer client who is very wealthy, but she's sort of inherited wealth from her parents. And her parents, it's very typical. Like her dad managed everything. Her dad managed her investment accounts, did everything for her. They had a very complex estate plan. She has no idea about what any of that is. And now that the wealth is transitioning to her, it's very disorienting. I'm grateful that she did some classes with some nonprofit groups so that she would understand at a high level who are the people she needs and what role do they play, and has a general idea of the direction she wanted to go in from an advisory standpoint so that she could pick and screen for the right advisor. And so I think that's also really important regardless of wealth level. I think you need to understand what is the role that your tax professional is going to play in your life? What is the role that your estate attorney is going to play in your life? What is the role that your financial advisor or wealth advisor is going to play in your life? And once you have that, until you have that, I don't think it's a great idea to hire an advisor from the guess that you think you need one.
I love that. I love the candor as well. I think that that's a really great take. One thing that I think is so critical about you specifically also helping women is that they're expecting over the next decade for women to be in control of over $30 trillion of US wealth,
Yeah.
which I mean, that is a huge shift. I think as an underserved market as well as I think a lot of times people look at women in wealth and they automatically equate their husbands to it or their parents
Mhm.
to it or however else. And
Mm.
so what I want to know from you is A, are you already seeing that transition happening? And then what kind of insights can you give over that type of transition?
100%. I do see it happening. I have so many clients who come to me either as having inherited money from parents or grandparents, having divorced from a spouse and their high net worth, and they're in the driver's seat for the first time. And that's a really exciting opportunity. It can be a bit daunting, I think, from a client standpoint, but it is very exciting because it gives them the opportunity to start from scratch and to really intentionally design their financial life and to really be in the driver's seat. I think from an advisor standpoint, I know that we talk about this a lot in our industry, but I actually find it very annoying that we talk about it's underserved because women are half the population. Like, I don't understand how you can just ignore half the population and think that like that's an underserved market. It just drives me bonkers. So I have to say it. But I would say from an advisory standpoint, one of the things that I see a lot of advisors stumble on is they go directly to strategy. They go directly to tactics and strategy. And I have the Swiss Army knife. I have all the tools and the tricks in my pocket. Okay, I got them. I'm just like every other advisor. We know what to do and how to, build wealth for folks and how to invest money and how to be really strategic. That is table stakes to me. And I think the issue that happens a lot is they lead with that and they lose sight of the fact that this woman is probably wanting to approach wealth a little bit differently. I think women a lot of times feel to your point earlier about us not as a society not being very educated, a lot of times they feel daunted that they don't necessarily have the skills or knowledge to be able to manage this effectively, and so they feel insecure and uncertain about what direction they're taking and what moves they're going to make. And if you imagine you have that mindset or that fear, right? And that one of that new client that I mentioned earlier, she received a lot of messaging from her family's advisor saying, don't go do something stupid, even though she's a grown woman who's very accomplished and very intelligent. They kept messaging to that. So there's that subconscious fear that you're going to make a mistake. And then you have somebody coming at you spewing jargon and talking about tactics and talking about really niche subjects from an investment standpoint, and that can be a clash. You can get there, but you have to start with the foundational things, which I would say are three. Think about legacy, right? You want to think about what is the long-term vision that that person is going to want. You want to think about who and what matters to that person and make sure that you have a really good sense of what those are. And then you also really want to understand where that person is starting from a knowledge, from an experience, from a sophistication standpoint. And when you have those three in mind, then you can get into and you have a really clear vision of where you're going or where this client wants to go, then you can get into the tactics, and that's what they're paying you for. When we start with the tactics or the strategy, we put the cart before the horse, and I think we can alienate a lot of these other demographics. Like, people, they don't want to be talked down to. They want good service. They want you to do your job and really know what you're doing. But when you lead with that, especially for someone who is managing the wealth on their own for the first time, that can be really alienating and I think drive folks away.
Absolutely. So when you talk about the strategy. So you've gotten the foundation with your clients, you understand their motivation, the legacy question, how much experience they have, but then now you're looking at them and you're like, "Okay, I wanna understand your goals so that we can
Yeah.
help get there." What are some of the strategies you employ, whether they are, a portfolio. I
Mhm.
don't know if you have a standard portfolio mix that you're like, this is what I like to live by, or if it's person by
Mm.
person. And then also, how do alternatives and private real estate, and how do you like, I would like to know kind of your strategy of how you.
Yeah. So I would say it really depends on the client. And I would say it depends on their wealth level, obviously, but then also their investment time horizon and what they need. If I think about my kind of bread and butter, run of the mill clients for me, they're usually someone that's between, 40 and 55,
Okay.
has a couple $1 million in a portfolio, and is high income, high cash flow. They're continually adding to their portfolio. What I'm typically doing at that point is doing a lot of tax management and being very intentional about tax location as they're adding to that. So really thinking about how are we going to be as tax efficient as possible. We do a ton of tax planning. Usually what comes from that is we are going to do a pretty run of the mill allocation for their 401ks, their workplace plans. Then we're going to do a lot of direct indexing for their taxable portfolios. Once folks are past, I typically say like 3 million of assets, then we're going to start to get into alternatives. It really depends on the client and what their interest is. A lot of my client, and I did not talk about this, but most of my clients are very values focused. And so they really have particular causes that they are passionate about. And so one of the things that we do in our discovery process is really identify what those particular impact pillars are, so that one, we can screen for their public equities portfolio and just make sure those things are excluded from, or that the portfolio is in compliance with those impact pillars and is not in violation of that. But then we also are going to think about adding alternatives that are in alignment with those particular impact pillars. So that can look like, I have a client as an example who had a business exit. She's very big on entrepreneurship. She's very big on women's economic empowerment. Surprise, surprise, when we're building out her alts portfolio, we're thinking a lot about angel investing in women-led companies, and giving her some parameters around how much of her portfolio she should allocate to that. We are doing a lot of investment in women fund managers. So from a private equity or VC standpoint, we're looking to allocate to women founded funds, or from direct investment standpoint as well. And even when we're not at women focused funds, or we are looking at how are we, if we're looking at fund of funds, like what are the metrics that those portfolio companies are moving that are actually going to be towards gender equity. So we'll typically do above 5 million, we'll typically do a fund of fund structure. And we have some preferred partners that we love that are really going to help us dial in that impact.
So you really, really cater specifically to the client and what their values are, but also kind of what they want to do on all scales of the time horizon. So you're not just looking at like over the next 5 years. You're really building them out like through retirement, even at the age of 30. You're like, yeah,
Yeah.
no.
For sure. Like we're building it out because, one, I mean, I'm young. I'm going to be in this business for a long time. I'm going to be with them for a long time until I retire, right? And I want to make sure that directionally we're moving in the right pace. It's not just about, oh, there's this exciting investment opportunity that came across my desk. Yes, that's great. However, that doesn't necessarily, if it's not in conjunction with a long-term strategy, then it's really not in their best interest, in my opinion.
Well, you also spoke, which I was like kind of shocked about, that you talk about angel investments or startups. And I think that's kind of a scary, I think, topic for a
Yeah.
lot of RAs. They like to really be playing in like that safe box of
Yeah.
assets and allocations. So
For
when you mentioned
sure.
that, I was like, oh, so she's willing to take some risk alongside her clients.
Yeah, I mean, listen, I'm an angel investor myself, and I'm not saying that I do due diligence on every deal for those. But what I am saying to a client is, if you are in the circles where opportunities are coming across your desk, I want you to understand how much is prudent, how you should be screening for those, and to have like a real investment thesis or mandate, so that you don't just create some random portfolio of things, right? So it's giving them kind of dollar bound boundaries, dollar wise boundaries of, hey, we don't want to exceed this percentage of your portfolio. So don't go crazy and just writing checks. And also, let's not compromise your long term financial health because you want to just write a bunch of checks. Let's be intentional, or just because you like the founder, like, let's make sure that you're not overexposed in any particular sector or industry as well.
Wonderful. So when you're looking for those alternative allocations for your client, like if they're saying, "Yeah, I really want this,"
Mhm.
where are you finding them and how are
Mm.
you making sure they match those pillars?
Yeah. So I would say I do a lot of networking, and so I have a lot of fund managers in my network that help me do that heavy lifting. Other advisors that I know that are very values focused, so they'll also share investment opportunities that they're becoming aware of as well that may be of interest to my clients. That's incredibly helpful. I'm part of a mastermind of other RIAs and advisors that are values focused in terms of their client offerings. So that's a place where we'll meet every quarter and just talk about some of the investment opportunities, some of the best practices that we're doing from a portfolio construction standpoint. It's incredibly valuable. And I would say for me, I think the last thing I would say is sometimes my clients come up with great stuff. Like, some of them are really well connected and they get great opportunities that come up, and they're really exciting, and so we'll go from there.
Fantastic. So as a company that is, I mean, I feel like you guys are quite specialized on what you do. I wouldn't call you a generalist by any sense of imagination. How are you all delivering this on like an operational standpoint? Like, are you guys using traditional infrastructure and like the type of reporting? Do you guys have your
Mm.
own? What is it that you
Yeah. So it depends. Like, from a public equity standpoint, like, we are very tech forward. I mentioned efficiency, how I love finding efficiencies. It's not just in clients' financial plans. It's also just in life and ops as a standpoint. Like, we're very systematized. What I am typically doing is we use Altruist as one of our custodians, which makes life so much easier from a reporting standpoint, from an invoicing standpoint. It really just is the cornerstone of our offering. From a reporting standpoint, it really depends on the client. Like, we're not using a Black Diamond or anything like that, some of these other like reporting softwares, but we do like custody any alts assets like on their client on their statements.
Speaking of, like, being specialized, but you mentioned a lot about, like, tax planning and that kind of thing.
Mhm.
So on your staff or your team,
Yeah.
do you have, like, estate planners and tax people,
Mm.
or, like, how's your team built?
Yeah, so we are a team of 4. We have 1 paraplanner and 2 financial planners on our team, and then an ops person. Our main process is actually, so I typically am meeting with clients, but only to present our findings. So my team will do the discovery of their documents, like, have those meetings. We use Right Capital for our planning software, and we use Hazel AI and Plan for tax planning. So that's our real tech stack. That plus our specialized like knowledge and experience is really what we're doing. So we are definitely, I would say, I'm very grateful for sort of the first half of my career in this industry, because I spent a ton of time really just focused on efficient transfer of assets. So really doing a lot of estate plan, like working under really sophisticated, very experienced tax and estate planners. And so that gave me an incredible foundation to be able to say, yes, I can play here. I know enough to be dangerous, and I can give my clients a lot of perspective that they can then take to their CPA or their tax planner. I'm very like, our team is very big on continuing education, and we do a ton of not just phone it in, I got my hours, continuing education, but actual, like, real sophisticated estate and tax planning education to make sure we're appropriately serving our clients.
Oh, that's fantastic. Our company, we actually just did our very first CE webinar on
Ooh.
multifamily to really like help the RAIs. And I am actually very excited to start getting into it a lot more and actually being one of the people who can offer the credits, because educating like you're talking about is actually one of my favorite things. That's why I do Wealth Unfiltered. I'm
Mhm.
obsessed with helping people do things on all things education. And to me, it's like this is a fun way to do it is through a
Yeah,
podcast. So bringing
absolutely.
someone like you to the table is so exciting. And then I get to learn a lot too, because that's also one of my favorite parts of this job. I want to kind of transition a little bit to a couple more questions about alternatives. So one thing I want to know is, have you guys really gotten into real estate? Have you used those for tax advantages? What part of the portfolio, or what percentage do you allow?
That really depends on the client. I would say there are some clients that come to us. For example, I have a client who he's a perfect profile for alts and real estate portfolios, but he has huge like family interests in real estate. And so it just doesn't make sense to to allocate anything new that we're doing to real estate because he has significant exposure. So it really depends on the client. Yes, we certainly do allocate to real estate. Because we're values aligned, I would say the vast majority of our real assets or like real estate allocation has to do with affordable housing and then thinking about like infrastructure for like climate friendly infrastructure. So that's our main focus and has been for several years.
Has any of these new policy shifts and all of the things around the affordable housing really impacted your
Big
business?
time. Big time. So there was a fund that we were looking to allocate to, or like we were putting in front of clients. So we're not setting up, just to be clear, we're not setting up SPVs or anything like that, but we are sourcing opportunities and saying, putting it in front of clients and saying, this is something that we think might be of interest to you. But there was a fund that we were interested in allocating to that was going to do some really exciting affordable housing projects earlier this year. And that, oh, sorry, earlier last year, excuse me, and that has really just dried up. It's dried up completely, which has been a challenge. I do think that there are certain jurisdictions where they are still very much allocating to affordable housing and they're continuing to expand in that area and prioritize that. But nationwide, I would say it's definitely slowing down.
Yeah, I can imagine. We're impacted and we're watching all of the policy shifts and changes, but
Mhm.
it's interesting from an RIA perspective. How has
Yeah.
that been?
I think one of the things we've been focusing on in light of a lot of regulatory changes from a green, like energy standpoint, a climate combating climate change standpoint, and from an affordable housing standpoint, is thinking about what are the asset classes and what are the types of investments that you can make that are going to not have the additional risk of exposure to regulatory changes, right? Despite the changing regulatory environment, what are some areas that you can do? And so thinking about with my client that I was making as giving as an example, like she doesn't have to, yeah, she may be interested in investing in affordable housing development. That's a bummer if it's not the case. But she can also just say, I'm going to allocate to that in the future. For right now, what I'm going to allocate towards is make sure that I'm investing in women owned private equity firms or women owned VC funds and just going from there instead of saying I'm going to be held up by some regulatory changes. So it's operating within the environment. And there's always environmental changes, regulatory changes that happen. It's really just about adapting accordingly and not getting too hung up and not being overexposed in one particular area, over focused on one particular area.
Absolutely. So I have one final question for
Okay.
you. My question is, so the advisors listening who really want to continue to build the next generation of the high net worth individuals coming on, those types of
Mhm.
clients, what is something you learned the hard way that you could either you wish you didn't learn that way, or that you would advise onto them and say, this is what I would do differently?
So I'm going to answer your question, but I'm going to answer it a little bit differently. I will tell you what I see as the person that continually poaches clients from from their parents or grandparents advisor. I see a lot of condescension that comes from the advisor towards the inheritor. So I tell this story a lot, but I'll share it here. I have this client who is incredibly sophisticated, incredibly intelligent. Like, think she's very senior in like the art world.
Right.
Very smart woman, has a PhD, very smart, very articulate, just a delightful woman. She has gravitas to her and she has a presence to her. And she came to me because her grandfather passed away and she was inheriting money from her grandfather. And so she went to meet with her grandfather's advisor. And I'm not gonna say it was sinister, but I think it was an attempt at connection. He said, "Oh, girl, you're gonna buy a lot of shoes with this money." And you think that was an immediate turnoff. There were other things that that person did that clearly drove her away, but that prompted her to start a search for another advisor. And that was a couple of $1,000,000 that walked out the door, all because there was sort of a condescending trope that that person used without actually understanding them. So I would say, first and foremost, you have to be willing to listen to the next generation and understand what they want. Don't assume that what their parents or grandparents or whoever they're inheriting the money from was okay with is going to be okay with them. First and foremost, I think secondarily there is also like the ease of doing business. Millennials and down very focused on like how technologically native the experience is, how seamless the experience is. Are you making it hard for absolutely no reason for them to do business with you? Those if you do those 2 things right, I think you're gonna be in an incredible place. Those are the 2 things that I see clients coming to me and really complaining about or citing as a reason that they ultimately broke away from their family's advisor.
That's great advice. And I actually never thought before about if you're now almost you're inheriting that person as a
Mhm.
client
Yeah,
because of like losing someone,
yeah,
automatically thinking, okay, well, it's going to have the same investment mentality.
yeah.
I never thought about that, but I could see how that's a huge disservice to the client and to
Sure.
yourself.
100%. Like, it's not you think you have clients and you have tens of years, decades sometimes of experience and rapport and understanding who they are, or even just conditioning that client to the way you do business, which is great. And all of us do that, right? Like, we all do that as advisors. But you have to think you're starting from scratch. Even though you have custody of that assets, like you are having to build trust and rapport and understanding and understand this person. They are going to be different than their parents or whoever your original client was. And so it's really up to you to understand them and to take time to get to know them, because then otherwise you're just likely pushing them away.
Absolutely. Well, Anna, I cannot thank you enough for taking the time to join me on Wealth Unfiltered. For anyone who's listening who maybe is about to have a liquidity event or they might be ready, or they're like, actually, I'd like to go ahead and transition over to Anna because I am
Mhm.
not happy with my financial advisor.
Yeah.
How can they find you?
Yeah, so you can search my name anywhere. I hang out mostly on LinkedIn and on Instagram from social media standpoint. So it's Ananjai Conte there. Our firm website is Poder Wealth, PODERWEALTH.com. Very easy to find. And we have a simple form there. You can fill out a form and just inquire and reach out.
Fantastic. Amazing. Thank you so much. And thank you to all of our listeners for joining us again. Anna just walked us through what implementation looks like in a modern RIA. And every conversation across this series with Phil, Andrew, Jake, Ramez, and Anna all have one theme that prevails. The technical stuff is the easy part, but the client conversation is what makes it hard. To close out the series, I sit down with Brian Portnoy, one of the leading experts in psychology of wealth. He is the founder of Shaping Wealth and the author of Geometry of Wealth. You're not going to want to miss this episode.